U.S. natural gas futures rose about 3% Friday, despite a slight increase in output and reduced gas flows to LNG export plants. July contracts settled at $3.78, up 9% for the week, driven by expectations of higher demand as LNG facilities wrap up maintenance and hot weather boosts power generation. Meanwhile, rising storage levels continue to cap prices. Inventories are 5% above average, and another triple-digit storage injection is expected, potentially matching a record streak last seen in 2014. Spot prices remain weak, with Henry Hub trading around $3, well below front-month futures. Traders have taken advantage of this spread by storing cheap spot gas and selling futures for arbitrage profits. Production in the U.S. fell slightly in June compared to May but remains near record highs. Weather forecasts point to continued above-normal temperatures through mid-June. Gas flows to major LNG plants are down to 13.8 billion cubic feet per day from 16 billion in April due to ongoing maintenance and brief outages. Sabine Pass hit a 23-month low, while new capacity at Plaquemines LNG reached record levels. Maintenance at key export terminals is expected to continue into late June. Meanwhile, U.S. natural gas producers appear to be gearing up for increased output, with the active gas rig count rising sharply over the past 2 weeks to 114. Despite this clearly bearish signal, the market has shown no reaction as prices continue to climb toward the $3.80 mark. Given the growing downside risks, this move seems puzzling if not outright speculative. Meanwhile, the upcoming Kitimat LNG terminal in British Columbia, set to begin operations in 2025, could affect U.S. natural gas prices by shifting supply and tightening the North American gas market. With 1.8 billion cubic feet per day of new LNG demand, Canadian gas that typically flows into the U.S. may be redirected to feed the terminal, especially from the Montney Formation. This would reduce available supply in regions like the U.S. Midwest and Pacific Northwest, increasing reliance on U.S. production and supporting higher prices. Kitimat's demand also contributes to a tighter continental supply-demand balance. Though it's a Canadian facility, it draws from the same interconnected system as the U.S., indirectly putting upward pressure on Henry Hub prices. Additional LNG demand year-round could reduce seasonal price dips, especially in spring and fall, and may raise spot prices in western U.S. markets if pipeline constraints emerge. However, several factors could limit its impact. Canadian producers are ramping up output, which may offset export demand. Kitimat also doesn't pull gas from U.S. fields directly, unlike Gulf Coast terminals. And if global LNG demand underperforms, Kitimat may run below capacity, softening its effect on U.S. prices. Overall, Kitimat LNG is unlikely to cause a sharp spike in U.S. prices but could provide modest support, especially in regions closest to the Canadian border. Its full impact will depend on Canadian supply growth, infrastructure limits, and global LNG market strength. I would normally expect a bearish reversal next week, but given how irrational the market has been lately, that may not happen. If natural gas manages to settle above the $3.80 resistance, it could push toward the next target at $4. On the other hand, if prices fail to break higher, we could see a pullback toward the $3.65 support level, with the potential for a further decline to around $3.50, where the 50-day moving average offers additional support. Please like, subscribe, and comment to support the channel. See you in the next one.